Tax the rich. Probably the simplest sentence in American politics. Most people agree with it, and more or less, the polling has been consistent for over a decade now. But why? What does it mean to tax the rich? Or another saying, eat the rich. The 400 richest Americans, according to a research piece by Sazan Zuckman, now pay an effective tax rate of 24%, lower than the bottom 50% of US households. Somehow, some billionaires even pay almost zero tax. In fact, in just 5 years, billionaire wealth worldwide has almost doubled to 18 trillion. And so you think, given the polling, given the gap, given that this has been a campaign promise in basically every election since 2016, that something's been done about it by now. I wanted to know why. Like, what would actually happen if a country tried to tax its wealthiest citizens? So I put in some work and built 3 scenarios, 3 guys, 3 different policies, and 3 different scales of wealth. Henry has about 500 million. He runs a hedge fund. He's the high end of rich, but not the guy you picture when you hear the word rich. Bernard has 14 billion, self-made tech founder. He's more of what you'd expect of the modern rich class. Elon has over 500 billion. He's a category of wealth that didn't really exist 40 years ago. We are going to put each of them through a different version of tax the rich, a moderate one, an aggressive one, and the one that a lot of people actually mean when they say the phrase. This is Henry. Like I said before, Henry runs an extremely successful hedge fund, just over $500 million in personal net worth. Due to his recent success of his hedge fund, he pays himself a salary of over 100 million. Most of it goes into equity in his own firm and in concentrated positions as in publicly traded stocks. Alright, so it's a Tuesday. Henry is in his office and the news cuts in. A populist senator has just gotten his bill through. The Billionaires Income Tax Act, applying to taxpayers with either 100 million in annual income or 1 billion in assets for 3 consecutive years, affecting fewer than 1,000 US taxpayers. Henry is one of those 1,000. The thing about Henry though is that he already knew exactly what was going to be in it. There's a concept known around Wall Street called buy, borrow, die, originated from the mid-90s and has been one of the primary ways to avoid tax. Basically, in short, you buy the asset, you borrow against it to fund your lifestyle, loans on income so no tax. Then you die. Your heirs inherit at stepped-up cost basis, meaning the value of the asset is now what it was at that person's death, and the gain disappears. The IRS never sees a dime of what the asset actually earned. And let's just say Henry knows a little bit about this. But the billionaire's income tax is specifically designed to kill this game. And so Henry does what every wealthy person does a moment a tax bill passes. He calls his attorney. Now, what Henry's attorney does over the next 90 days isn't illegal. It isn't even particularly crazy either. It's the same thing every estate attorney in Manhattan has been doing for 40 years, just dialed up. Here's what the bill actually does. For publicly traded assets, stocks Henry holds in his brokerage account, the IRS now treats the end of every calendar year as a hypothetical sale. Whatever those positions went up by, Henry now owes capital gains tax on, right then and there, even if he didn't sell a single share. That's the mark-to-market rule, and you can't escape capital gains tax anymore. Henry's public positions appreciated about 40 million last year. His bill came out roughly $10 million in cash that he does not have because he didn't sell anything. So what does he do? Well, unlike in the other scenarios, there's a light at the end of the tunnel for Henry. When he picks up the phone, he does it calmly. They've already discussed something like this 6 months ago. The play isn't to make the tax disappear on the public stuff. He can't now. So 1-0 Henry. The real play is to stop holding public assets in the first place. And so what you see is that over the next 18 months, Henry gradually converts his publicly traded assets into private ones. He co-invests in a private equity fund. He takes stakes in closely held businesses. He moves capital into real estate partnerships. These are all considered investments too, legitimate ones, but they have a different treatment under the bill. Non-tradable assets don't get marked to market annually. They get a deferral charge at the point of eventual sale, an interest fee that's meant to approximate where the tax would have been. But the important part is that they don't come due every December 31st. Private assets also have another advantage. The IRS can't pull a price off a screen. Henry's private equity stake, what it's worth right now, today, well, you wouldn't know until it actually sells. Henry isn't the only one doing this, by the way. All 900 or so households the bill targets are being restructured in real time. In other words, they knew what was going to be on the bill too. So the question becomes, does this bill still raise money? And the answer is yes, it does. Just less than you think. The Penn-Wharton budget model projected around $500 billion over 10 years, mostly from the transition tax on publicly traded positions in the first 5 years, which is the real money that actually has to be paid. Okay, so $50 billion a year over a decade is roughly what it would cost to make community college tuition-free in the United States for 10 years. Or it could serve as a revenue to boost the IRS's effort for more money. It's not transformative in the scale of what Eat the Rich implies in the slogans, because the rich aren't being taxed or eaten that much. So 1-1 Henry, he's even, but some people want more. Hope you guys like the GTA inspired loading screens. Anyways, this is Bernard. Bernard founded a software company about 15 years ago. The company went public, the stocks did what tech stocks do, and Bernard now sits on roughly $14 billion in net worth. About 80% of it is locked up in company stock he hasn't sold. Bernard, unlike Henry, is a billionaire, like billionaire. He's also in a different psychological category. Bernard is the kind of wealthy where the wealth in a real sense is his identity. The company is him, and selling means something different. Alright, the bill that just passed isn't a moderate one anymore. This one's bigger. The senator behind this one tries something different. They're trying to redefine the tax base entirely. The proposal imposes a 2% annual tax on every dollar of household net worth between $50 million and $1 billion. For the billionaire class, the legislation adds a 1% billionaire surtax, bringing the annual total tax to 3% on every dollar of net worth above $1 billion. So 3% annually on every dollar above $1 billion. Let's run Bernard's number. So $14 billion in total, $13 billion of which sits above the $1 billion threshold. 3% of $13 billion is what, $390 million? Plus 2% on the $950 million between $50 million and $1 billion. That's another $19 million. So let's get this straight. Bernard now owes the IRS over $400 million this year. And here's where this scenario diverges a little bit from Henry's, because Henry's tax was a one-time event tied to a specific year's appreciation. Bernard's is annual. It comes back next year and the year after, and every year for the rest of his life. Bernard's attorneys, using scheming magic, can shelter a portion, but not enough. The rest has to be paid in cash every year. And Bernard does not have $400 million in cash sitting in a checking account. Almost no billionaire does. Their wealth is the asset, not in liquid currency. So Bernard has to sell. This is the moment where scenario 2 breaks differently from scenario 1, because when Bernard goes to liquidate $400 million worth of his own company stock, two things happen at once. The market sees a major insider selling. Algorithmic traders treat insider selling as a negative signal. The stock price drops on the announcement alone, sometimes before the actual shares even clear, and his selling adds supply to a market that it wasn't expecting. 5% of his stake hits the market. The price drops further. By the end of the quarter, Bernard's company stock is down meaningfully. His remaining net worth, the $13.6 billion he didn't sell, is now worth less than what it was at the start of the year. Next year's wealth tax is calculated on that new lower number, but he still has to liquidate again and again and again. Now multiply this. There are roughly 900 American billionaires. The wealth tax targets them all. Every single one of them is doing the same thing Bernard is doing every quarter. So let's see what happens to the entire market in aggregate. That's not Bernard's portfolio anymore. You're looking at the stock market. It tends to happen when concentrated equity holders are forced to liquidate on a synchronized schedule. Pension funds that hold these stocks in their retirement portfolios, teachers, firefighters, anyone with a 401k heavy in US equities feels it. Not because they own anything Bernard owns directly, it's because the market that contains all of the holdings just took a hit. This is the part of the wealth tax debate that doesn't make it into the slogans. The wealth being taxed is structurally embedded in the same equity markets that holds ordinary retirement savings. You can't really extract it without affecting the people who have their retirement savings in the stock market. And you know Bernard, he cares about the retirement savings of the people. So Bernard, watching all of this tragedy, does what wealthy people across Europe started doing 5 years ago. According to a highly cited 2025 Henley Private Wealth Migration Report, an unprecedented and record-breaking 142,000 HNWIs were projected to relocate internationally in response to punitive evolving tax regimes. The United Kingdom lost 16,500 millionaires in 2025 alone after the reform package, capital gains rate hikes, and the elimination of non-dissimulated resident rules. France lost 800, Germany lost 400 due to economic pressures, Spain lost 500 after the solidarity wealth tax. The destinations became Switzerland with a plus 3,000 net inflow, the United Arab Emirates with a almost 10,000 net inflow, Singapore with a 1,600 net inflow, Italy gained 3,600, and Greece gained 1,200, similarly after absorbing massive amounts of fleeing capital. Norway is maybe the cleanest case study for when wealth taxes, let's just say, go bad. As one of the few remaining OECD countries maintaining a recurrent net wealth tax, Norway experienced a highly publicized exodus of billionaires and UHNWIs, predominantly relocating to Switzerland following a fractional 0.25% increase in its wealth tax rate. 0.25%. The bill in this scenario, the American version, anticipated this. Warren's plan incorporates stringent anti-evasion measures. Most notably, this includes a 40% statutory exit tax on the net worth of any US citizen worth over $50 million who renounces their citizenship to emigrate to a tax haven. A 40% exit tax sounds aggressive, but there's a problem. The problem is enforcement. History proves this. It famously required an astonishing 12 years, 8 of those continuous litigation and negotiation for the IRS to reach an agreement on the taxable value of the Michael Jackson estate. 12 years to value one estate. Now imagine doing that for every billionaire who tries to leave. And so this leads to another problem with the wealth tax that nobody seems to talk about until they're actually inside it. How do you charge somebody 3% annually on a privately held company whose market value is genuinely unknown until it sells? Remember that you can't pull a price off a screen. You have to estimate. Every estimation becomes contested, and every contest becomes litigation. But this may be a move in the right direction if the bill is passed, because it raises real money. Projections by economists Emmanuel Saez and Gabriel Zucman indicate that the ultra-millionaire tax would generate $6.2 trillion over a standard 10-year budget window. That's a lot of money. Proponents argue that these funds could entirely finance universal childcare, tuition-free community college, the expansion of the child tax credit, and the lowering of Medicare eligibility age to 55. But just before we end Bernard's scenario, the modeling on the other side is real too. Economic modeling groups such as the nonpartisan Penn-Wharton budget model projected that Senator Warren's ultra-millionaire tax would ultimately reduce US GDP by around 1% by by the year 2050. And so Bernard's scenario lands here, but there's still one more level to the ladder. This is Elon. Now this man needs no introduction. I'm going to use the actual name here for clarity, but understand the principle applies to anyone at this level of wealth. Bezos, Zuckerberg, the handful of people with net worths above $100 billion. Elon's estimated net worth is 600 to 800 billion, derived primarily from technology and automotive. The vast majority of that is in Tesla and SpaceX stock. Now, this scenario is the one that most people don't realize is seriously being proposed in policy circles, but it absolutely is. It's called libertarianism. Libertarianism is a political and economic concept heavily popularized by Dutch political and economic philosopher Ingrid Robbins. Libertarianism argues for the establishment of a hard, unbreachable upper limit to the amount of personal wealth any single individual is permitted to accumulate, analogous to a poverty line, which defines the minimum economic resources required for a basic standard of living. Libertarianism proposes a riches line. Robbins suggests capping lifetime wealth accumulation at approximately 10 million per person. Under this paradigm, all assets exceeding this cap is subject to a 100% confiscation by the state and subsequent redistribution. Very harsh. Anything above this line, the state takes. It's a policy that's actually been growing real political momentum, especially in Europe and increasingly in younger American left politics. Now, let's assume that this happens aggressively all at once and run Elon under it. Here we go. If the state imposes a strict 10 million cap on an 800 billion fortune, the government is no longer asking for a percentage. It is confiscating 799.99 billion in a single stroke. Now, I want you to actually think about what that number means mechanically. Elon doesn't have $800 billion in cash. The wealth is bound up in equity, specifically public shares in Tesla and massive private stakes in the SpaceX and XAI conglomerate. To seize the wealth, he has to liquidate the equity. Let's just look at the public side. Tesla. Elon owns around 150 billion in Tesla stock, give or take 30 billion, or about 15%. As of 2026, Tesla's daily trading volume is somewhere around $20 billion on a normal day. To satisfy a tax bill of this magnitude, the market would have to absorb almost a week's worth of total market volume just from his forced selling in one go. And this is not counting Bezos selling Amazon, not counting Zuckerberg selling Meta, not counting the hundreds of other billionaires below them all liquidating simultaneously. I don't really know how to say this, but there are not enough buyers in the world to absorb that much concentrated stock at current prices. Not because the world is poor, but because the price was set by the absence of that much supply. When you flood the market with trillions in forced liquidation, it just collapses. Tesla goes down 15% on forced liquidation. The panic that ensues may bring it down to a fraction of the price in no time, because everyone knows what's going to happen. And the private assets? SpaceX and XAI's private valuations crater, because you cannot force sell hundreds of billions of dollars of private aerospace and AI stock without instantly destroying the speculative premium that gave it that value in the first place. The IRS now owes a tax claim against an asset class that just lost most of its market value in the actual process of being taxed. I want to say this again because what just happened isn't just Elon's stock portfolio. That's everyone's 401k, right? Where everyone's retirement savings are. Tesla is heavily weighted in nearly every major US equity index fund. The S&P 500 holds it. The total market index holds it. When the stock collapses under the weight of forced billionaire liquidation, every retirement account in America that holds US equities feels it. The wealth literally can't be extracted smoothly from the billionaire to the government to build roads. Basically, a massive portion of it is simply destroyed in transit because the asset class structurally cannot support being liquidated at that velocity. Now, this is the part where some viewers are going to say, fine, so what, let it collapse. Maybe the fact that one man's wealth can crash an entire equity market is itself the problem the cap is trying to solve. And that's a fair argument. It's actually the libertarian argument verbatim. Libertarians argue that extreme wealth is fundamentally incompatible with democracy, and that individuals possessing multi-billion-dollar fortunes wield widely disproportionate civic influence. So the response would be, yes, the market gets disrupted, but that disruption is the point. You can't fix a system this concentrated by being gentle with it, but what you're technically left with is irreparable damage done to the people you were meant to originally help. There's hope though. Assuming the policy is all successful, we managed to bring in trillions in one go, which would almost certainly allow for some drastic changes people want. An almost certain drawback will be that for every year forward, more and more of these people who are willing to build these levels of wealth will begin to leave if they didn't do so before. So let's pull all three together, because there are probably a lot of unanswered questions. Henry successfully restructured his investments into private ones, absorbing the moderate bill at a fraction of its headline rate. Bernard sold into a market that priced its selling against him, and a chunk of his neighbors, including him, started looking at residency outside of the country. Elon's wealth is, in a real sense, mathematically unextractable. But why? It just doesn't make sense. Is it really impossible to tax these guys? Well, the US income tax system was built about 100 years ago, and it was built to tax something very specific: wages. Money that comes from working, the kind of income that arrives in a paycheck on a schedule from an employer with the reporting obligation. Wealth doesn't behave like that. Wealth is illiquid. It's mobile across borders. It's valued by guests until it sells. It sits in legal structures, trusts, partnerships, holding companies that have been refined across centuries specifically to be untouchable. And this is not an argument against taxing the rich. I want to be very specific about that. The lever that actually moves the system is structural. It's the definition of what counts as taxable in the first place. Let's say you mark the market, the unrealized gains for the very top tier without trying to wealth tax everything. You collect on depreciation as it happens, instead of waiting for a sale that never comes. Now, some people may know where I'm going with this. That direct return from auditing someone below median income is barely $1 per dollar spent. Audits at this level don't even break even. But for taxpayers in the 90th through 99th percentile, that return rises to over $2 immediately. And when you include the deterrence effect, the fact that audited individuals voluntarily pay more taxes for up to 14 years afterward, the return exceeds $12 per dollar spent. At the very top, the direct return is over $6, with the full deterrence inclusive figure potentially reaching the multiples of that. Now, I just used the word deterrence a lot. What is this deterrence effect? The behavioral phenomena known as specific deterrence. Empirical evidence demonstrates that whenever a HNWI is subjected to a rigorous audit and forced to abandon illicit deductions, they tend to voluntarily pay higher taxes for at least 14 subsequent years. The primary fiscal value of auditing the ultra-wealthy isn't what's grabbed as soon as possible from them. The leverage is in the enforcement structure, in the closing of specific structural loopholes, in the redefinition of what counts as taxable income in the first place. But none of these things are slogan shaped, so they can't really fit on a t-shirt, and so they don't really get the political space needed. What's up, what's up, what's up? So if you may notice, the video is actually outdated because Elon Musk is now a trillionaire, so congratulations to him. I'm very jealous. And anyways, if you enjoyed the video, like and subscribe. If you disliked the video, then dislike and subscribe. But thank you for watching. Also, comment on the GTA inspired aesthetic, by the way. I don't know what I was doing. That was a little funny to me, to be honest. I don't even know why I did it. It was just funny to me, I guess. But let me know about that GTA inspired loading screen though. Yeah. And that's all I gotta say. See ya.